Right, here we go. Oh, don't you love the older recording in progress? Well, here we go. It is 7 o'clock for you guys. I nearly said 8 o'clock because I am actually sitting in South Africa. Isn't it wonderful, modern technology? So, welcome to those of you who are starting to drip in, which I can see. And hello, Adam. How are you in the hotter UK than I am in South Africa?
Well, indeed, absolutely fine. But I must admit, before this started, we were discussing the heat wave, and I wasn't aware you were in South Africa until we joined on. And it's, what did you say, 10 degrees out
It
there,
was
which
it
I'm
was
very
10 degrees.
jealous of.
Yeah, I had to wear long trousers today. Can you believe it? It's like
Long trousers.
it's
You
like,
would be
yeah,
a madman wearing long trousers in England
yeah. It seems to have been
today.
bonkers heat, doesn't it? I was reading that thing about the number of people who drowned in France or something. That they've been running
Yeah.
in, jumping into rivers and then drowning. It's mad, isn't it?
There's always someone worse off than you in terms of these waves, and that's horrible, isn't it? But
Mm,
yeah, France is particularly badly hit, isn't it? 45, I think.
yeah.
I
One of
bet
my
you.
friends told me that they all trains from somewhere like Birmingham to Euston had been cancelled or something because they were worried that the tracks were going to bend or something. I mean, it's just like you can't write it, can you? If it gets too hot, UK doesn't work, and if it gets too
And
cold, the UK can't work. It's like flipping
And
it.
it's beaten the 1976 heat wave today
Oh,
officially.
has it? Wow.
Yeah,
What a
that
kicker.
long-standing crown has toppled.
Wow. Well, you won't remember the '76
I
heat wave. I
won't.
will.
You
I think
do,
I,
yeah.
I think I
My
was still in
colleagues today.
I was still
Yeah,
in school at the time, but I do seem to
yeah,
remember it. And I remember it was flipping hot. Yeah, yeah,
yeah,
very, very hot. But
yeah.
no, so hopefully the people that are here are either sitting in their shorts or
Or in
they're
a paddling
on
pool,
their
or in the
oh,
cinema they tell you to go to. They tell you to go
oh
to the
really?
cinema because of the air conditioning. So
Oh
listening to the
right.
webinar whilst having a film on, that'd be a good idea.
Nice, nice. Or put, as you say, put your feet in a paddling pool so that you can cool your ankles off. That sounds like a
That's
good
what I've been doing. Luckily, we've got three paddling pools, one for each member in the family because of my
idea.
son. So
When we used to have a dog, we used to put the paddling pool in this weather, and the dog would just lay in the paddling pool.
it sounds lovely. That just sounds like a dream. Or being in South Africa, I might join you out there if it carries on so
Yeah,
much
yeah, yeah.
longer,
So,
Chris.
well, I'll be back in a bit. But anyway, right, here we go. It is 2 minutes past 7. So I think really, Adam, we might as well just crack on, don't you? We've
Should
got
we
some
crack on?
people come in. They've just joined as we go now. Basically, ladies and gentlemen, we are recording it. So if anyone wants a copy of it, let us know. And if you have any questions, do you want questions at the end, Adam, or do you want it as it goes, or would you prefer to finish and then sort of do them? I just know some of our guys like it during it, and some like at the end because it interrupts their flow. So, what would you prefer?
I don't mind them coming in. I think it works better at the end because often there's slides or ideas creating a question that might be answered later on. That often happens where people ask a question and then
Right.
remember you read them out. Don't never mind. Slide
Yeah. Yeah.
12 answered
It's
it.
fine.
So if you
Brilliant.
type up your question on the Q&A box that should be available on the screen,
Yeah.
then we can
Brilliant.
read these and answer them at the end. And if I don't get a chance to answer tonight, if there's quite a few, then I can come back to you separately after
Brilliant.
this
Right.
recording.
I am going to mute myself. I'm going to get rid of my ugly mug off the screen. Over to you. Off you go. Have fun.
Thanks, Chris.
Cheers,
Evening,
mate.
everyone. Thanks so much for attending this evening and hoping everyone is not too warm. I'm lucky this evening, actually. I don't want to brag, but I am in a basement. So, albeit every time I venture up the stairs over there, I get hit in the face with a wall of heat. I'm more than happy to be working late this evening, speaking to you guys as usual, but especially with the heat wave outside. So it's 22 degrees where I am now. It's not so cool up there. Welcome everyone. A lot of you here this evening may have already heard me on numerous or various webinars in the past. This evening we want to talk and discuss growing wealth and investment strategy, how to smartly plan for the future and your ideal retirement. So, what I would like to start with is just a little introduction to our firm. As I say, some of you here might already be clients, might have already dealt with myself or other colleagues on advice. And some of you may have logged into previous webinars in the past because I've done many with the Frank Taylor Group and other. But just to introduce ourselves to those who don't know, we're Specialist financial advisors to medical professionals. We don't exclusively deal with medical professionals, but we largely deal with dentists, doctors, vets, pharmacists through our links and experience in the field, and obviously being linked to the Frank Taylor Group. We're independent and whole of market advisors. We feel that is extremely important. It means that we're not picking off a menu. We're advising clients on the exact best thing they should do. We have no ties to providers or funds. We can recommend who we want and give the best advice. And if you use an IFA, whether you use us or other, we think that is extremely important to have an independent and truly whole of market IFA. The services that we offer, and we'll discuss a few of these this evening, but not all, because we've got, 45 minutes an hour as opposed to 5 hours. But we'll list the areas that we cover here. And obviously, if there's anything that you think, oh, do they maybe deal with this? You can ask after. We'll have my contact details at the end, and of course, sent to you after this webinar, and you can contact us for advice on these areas. We deal with investments and active management and portfolio management for clients, helping clients harness their investments and grow their wealth over time. Pensions and retirement planning. We specialize in the NHS pension. This is really crucial for a lot of you here this evening, who most of you probably do have an NHS pension and you're not sure maybe about what the benefits might be worth in future, how you're funding it, what allowances you're using, what the McLeod remedy recently will have done. We help a lot of new clients, even ones with existing IFAs, who say they just can't get their heads around this NHS pension with that side of advice. We give tax planning advice linked to financial management. We're not accountants, so we don't do tax returns, and we work with clients' accountants to get the optimal advice. But of course, a lot of the advice that we give and a lot of the topics we'll discuss tonight are to do with tax planning, because if you're able to not avoid tax, not use any loopholes, but actually just cleverly and strategically plan for tax and make sure that you control it in the best way possible, you're going to grow your wealth a lot more than if you just dilly-dally, sort of earn this, sell this, buy this, and I'll do whatever as long as I'm doing something, and suddenly the tax is not what you set out to achieve, and you haven't got as much in your pocket. So this is really crucial to financial planning the tax. We deal with a lot of insurance advice for clients. As you can imagine, being medical professionals, a lot of medical professionals need certain insurances, whether they're business owners or not, just the nature of being involved in your industry. And we help a lot of clients with that. And we also have in-house will writer and power of attorney writer, sort of estate planning for inheritance tax as well. So if you want help with any of those areas, let us know. A little agenda for this evening. We are going to talk about business structures and how you run your business or your work, and some of the pros and cons of the two main options, sole trader versus limited company. It's been a hot topic over the last few years, and the sort of differences keep changing for good or bad of one or the other, including in the last budget. But, there's certain instances where one would be better than the other and vice versa. So it's just to sort of go through that. It's really important for people who are on the front foot to keep considering these options, as opposed to saying, I'll set up as a sole trader, I'm going to stay as a sole trader forever. Should always be looking just in case. It's better, could save you a lot of money. We'll look at income and tax planning, which ties in with that, but also into other areas of your working life. Pensions always should be the absolute focus for your financial planning. They are still by far the best place to save your money. Huge amounts of tax relief on offer. You have to be wary of allowances and save into them in the right way. But they are still by far the best way of growing your wealth over time. Growing wealth doesn't just take the form of pensions. We will talk in the next section about other investment options you should consider, and the benefits of those over pensions at certain times of your life, especially when you're younger and you've got longer to wait to access a pension. Talk about some options for investment strategy, and then we want to dig into market performance. Markets have been very, very strong, and we want to look at some facts and figures about those and different risk levels and how you might manage your own investments a bit better to maximize the returns that you get. We'll start with business structures. We often deal with clients who are reviewing, whether before we've spoken or not, or have recently changed, or are prompted to review their structure. That doesn't mean that everyone should be limited company. Doesn't mean that everyone should be sole trader or partnership. The devil is in the detail about what you want, how much money you're bringing in, what your future plans are, what your marital status is, whether you're able to fund pensions if you don't have large NHS pension contributions, these sorts of things that, really do decide what may be best. And we often help clients with analysis. Of course, your accountant's best placed to give you this advice because that's their job. However, we jump in to help assess this with your accountant or independently. The pros of being a sole trader on this screen: simple, one tax return, just you as your sole trader accounts, with your other income sort of included. So lower fees, less hassle, just one return. If you're a business owner, you've got an NHS contract in place that's in your name, you can't incorporate it. So you just got to sort of leave everything together. That's another benefit for organization, generally simpler, as we've said. And if you're earning, doesn't matter how much you're earning, even if you earn 800,000 a year, but you say, well, I need all that money, I spend all that money on my lifestyle, on my children, or whatever, on cars, on clothes, meals out, holidays. If you spend it all, there's no point in incorporating and taking all the money out. You're not going to be better off. We'll talk about limited company in a minute, and it's more control about if you make a lot of money, you don't necessarily need to take it all out and pay a lot of tax on taking it out. So if you need all the money you're earning, then it's highly likely that, if you are sole trader, that's going to be probably the right option. You should still review though, because you never know, and you should have a look. The cons: less control. What you earn and the profits you have is the profits you have. You can't spread, if you're a sole trader, very easily, income with your partner and children. We often see sole traders, oh, I pay my partner 20,000 a year. I'm earning 300,000 a year. I pay my partner a salary of 20,000 a year. Well, that helps a little bit, but it doesn't help a lot, does it? It could be much, much better in terms of tax saving if you were maybe to go a different route. You can also, if can't include your children very easily on that until they're adult age, so less flexible in terms of those options. If you earn over 200 grand, and this is often overlooked because accountants, people who don't have IFAs, they think, oh, my accountant will help with this. And I've never met a client who's on the ball with this themselves because it's a very complicated, newish calculation called tapering of pension allowances. If you earn over £200,000 a year now, it used to be 110 a few years ago, but now 200, you might have reduced pension allowances, which means you might be adding too much to pensions, either through NHS contributions or personal. We often step in and deal with people who haven't dealt with this before at all, and their accountant's clueless, or their accountant's done it and has done it wrong, or their IFA's done it and has done it wrong. It's the most common misadvice I see. So if you're earning a lot of money, taxable income, you should look at this and make sure you know your pension allowances. Because as I say, you want to use them. You want to use them to get tax relief, but you need to make sure you know what they are. And there's ways that you can get around that even without incorporating. And finally, if you're sole trader, all the tax on your business sale, if you do indeed own a business, is on you. That might not necessarily make much difference. We'll go into that later on, but it might do. Might make a big difference. So it depends on the value of your business and the gain. So pros and cons there for sole trader. Limited company, we are more increasingly seeing people go in limited company, especially in the last 5-6 years. I myself am a limited company. Much more control. You choose how much you pay yourself to an extent. It depends what other business owners are there, but you imagine it's your company and you have shares with you, maybe with your spouse, and your profits are X. You choose how much you pay yourself as salary and dividends. You can pay pension contributions direct from the limited company, get corporation tax relief. And if you don't need the other funds, you leave them in there, might roll them into growing the business, might roll them into investments within the company. You've got much more control about how much income tax you pay. And the allowances, like we said, that tapering of allowances, you can make sure you don't fall foul of that. You can add your spouse and maybe your children as employee shareholders, for your spouse usually, to distribute profits with lower tax. We'll talk about that and do some examples in a bit. Again, if you're sharing ownership with your spouse and or children, you might spread the capital gains tax liability across more people, save a chunk of money. You might save a little bit, you might save a lot, depends on the scenario. You're always going to save though. You're never going to be worse off having assets shared with other people. You can pay for more things potentially as well through the company. So some insurances and other tax deductible expenses, best to go to your accountant to work out the ins and outs. But certainly with what we do day to day, there might be a little bit more that you can claim off your profits. The cons are obviously, and why a lot of people don't do it, it's hassle. You know, you've been sole trader. If you are indeed sole trader, you've got to incorporate, you've got to pay the money, you've got to faff around with your accountant, you've got a company tax return, a personal tax return, you've got decisions to make about how much money you pay yourself. Sole trader, you don't decide it, you just earn the money, you pay the tax. There's more decisions, more hassle. You've got costs of setting up. If you're a business owner with an NHS contract, you cannot move that into a limited company. What we often see clients doing or have done is they incorporate their private income and they keep their NHS income sole trader. And you think that sounds like a right nightmare, but in lots of instances, it can save people a lot of tax and give a lot more control, even doing it split. So you know, different strokes, and it depends what you want out of it. But of course, there can be added complications. Um, which should be considered. Um, and recently, you know, there has been more of a gap closing on the difference in tax between limited companies and sole trader earnings. 4 or 5 years ago, it was quite substantially better. Limited company, dividend, income tax, corporation tax being lower at 19%. Corporation tax has gone up, dividend tax has gone up a little bit. So it's closed the gap, which means that, you know, there's more scenarios where sole trader is better than limited company, but equally there's going to be lots for either side, and there's most of our clients are limited company. So this is one. After today, rather than come to me to look at, go to your accountant. They are best placed, and they should be advising you on this, not just once when you set up, but every 2, 3 years, it should be a conversation. That's what you're paying them for, to say, with the amounts of money, with what I want to do, with my spouse's situation, my situation, is it worth looking at this again? And if you don't feel you're getting that advice, you need to either come to me or go to, you know, go to somebody who can help you with this assessment. I've listed here a very common scenario for a business with good profits, with an example business here, limited company, two shareholders. Uh, you can keep your income at 100,000 each if that's affordable. 100,000 is the optimal amount for paying yourself before you start losing your personal allowance. Over 100,000, between 100 and 125,000 earnings, you start losing your personal allowance from 12 and a half grand to zero, basically. And it means that in that gap, it's the highest tax in the whole UK tax system. It's about 60% tax in that bracket. So if you can afford it, most people cap their income at 100 grand each. And if there's two shareholders, that's 200,000 before tax. And then, of course, as I say, with retained profits, you can sort of save up and reinvest in the business or keep the money in there. An example of 400 grand profit before tax going into a business. We assume in this scenario, people pay 60 grand each for each shareholder into a pension, which you can do from a limited company. That comes straight off your corporation tax bill, saving 25% corporation tax on the 120 grand. In this instance, 100 grand salary dividends, you pay yourself 12 and a half grand salary and the rest dividends. That's how it would usually work, up to 100 each, and you get 156,000 left over after tax. And then retained profits after all that and corporation tax, 10 grand. That's the most typical scenario. Okay, we'll look through some others later, but that's a quite common one for those sorts of earnings. But again, it says at the bottom, you need to speak to your accountant about this, and always keep reviewing, because even if your profits don't change substantially, if they're kind of just, you know, ticking along, which is kind of good, you know, there's no criticism in just ticking along, going up and up gradually. Rules change and suddenly, this is why you want to go this way. Tax on sale, that's another thing to consider if you're a business owner. The rates have gone up recently with the Labour government, at odds with what they said initially about supporting small companies. They've done the absolute opposite, as a lot of you here will know, as I know, in terms of national insurance increases, capital gains tax increases, business asset disposal relief, business relief. Everything's been made worse, and that comes at a time where the costs of running a business are even higher, with energy costs and staff costs. So they have not supported small businesses at all. I'm not sure if the new Prime Minister will be any better, but if the government changes in future, it might change. The business asset disposal relief has always been there. First £1 million worth of gains that you make from selling businesses taxed at a lower rate, capital gains tax wise. It used to be 10% 2 years ago. It's now 18, so it's gone up a lot. But 18% is still substantially lower than income tax rates. It's still substantially lower than the normal capital gains tax rate of 24%. So it is still a big chunky saving against earned income. And against the normal capital gains tax rates, but nonetheless, it's nowhere near as good as it was before. We've shown an example here about selling a business worth 2 million and 1.5 million of it is gain, based on one person owning the business as a sole trader or two people as a limited company with 50% shares each, and shows the capital gains tax bills there, nearly 300,000 for the sole trader and 268 for the one with shared across. That's because with £1.5 million gain, that whole gain in the second scenario with two shareholders would be at the lower rate, whereas with one shareholder, the first million would be at the lower rate, the rest would be at a 6% higher rate. So it's 30 grand difference in this scenario, and the more valuable the business, the more difference there may be. But interestingly, we'll look at some scenarios later where there might not be a lot of difference for businesses with lower gain values or lower value sales. But something to consider and bear in mind. Spousal split. So this is talking specifically about what we've already referenced about a split of business ownership. Doesn't mean that everybody here should think, oh, I own a business, I should have it in both of our names. But we often see benefits in terms of, especially income tax, but potential capital gains tax with this. It needs careful thought, but these are some examples of scenarios. And if one person owns a business or the income is split between two people, it's always going to benefit you. It's just how much does it, and is it worth the efforts of going through it? Usually is for especially high earners. Spousal split, before I get into these figures though, is much broader. We often, every client of mine, I've got 280 clients at the moment in terms of ongoing retainer services. And we deal with many more as transactional business. And I've only spoke to a handful that have truly equalized holdings as a spouse, as a couple, I should say. And these are normally people who met in university, studied together, dentistry, for example, and then went and worked kind of together and joined the NHS at the same time. And they both got the same size NHS pension, have both done pension contributions, ISA at the same time, and split everything. I've got a few, but not many. And most people are lopsided. That's just the nature of how it goes. Myself and my own wife, it's not exactly equal. Of course, it's going to be like that in terms of your assets, but there is no capital gains tax event when you transfer asset ownership between spouses. There is when you transfer assets to children, or it's deemed as if you've sold them. You have to pay capital gains tax as if you've sold assets if you transfer shares to kids, but not between spouses. So you can, for example, transfer shares in your limited company to your spouse if you choose to, and there is no capital gains tax liability. It's really important to review not just with your business, but as a wider strategy. If you have properties that I own a business and I've got 4 properties, my wife doesn't have any properties and her income's 30 grand a year, or my husband's, earning 40 grand a year and he's got 1 property, but I've got 2. Be clever with how much income tax you're paying. Is it right? And when you're married, it's legally kind of yours together, really. So consider that as an option of holding things a bit more equally to pay less tax. And this shows examples of the first example, just simply a business with £1 million value, £600,000 gain on that value, and it makes 200 grand a year. One person earning 200 grand a year would have 117,000 or 118,000 net after tax, and 2 people splitting the income equally, 137,000. This is sort of just income tax. We're not talking about the other benefits of pension contributions, and there's many more by splitting ownership of funding both pensions. This is just purely receiving the money between 2 people. But in that scenario, it's 17% higher. And you imagine that per year, that puts a lot more in your pocket. Interesting though, in this one, because there's £600,000 gain on the business, if that's sold at £600,000 gain, It doesn't make really any difference to capital gains tax. The only difference is there's an extra £3,000 capital gains tax allowance on sale, which makes barely any difference, a few £100. So that's an example where capital gains tax wise doesn't make a lot of difference, but income tax very much so. And then down the bottom, we've got a slightly more valuable business with more gain, more profit per year, a couple of rental properties, for example, and we've shown example of capital gains tax and income tax for these as well. So income tax wise, you've got 192,000 versus 204. So less of a difference, less of a difference with higher income. That's if all of it's paid. That's because both would have 150,000. You remember I said after 100,000 tax gets bad. So both would be in the bad tax region. If it was limited company, you wouldn't take all that money out. We don't want to overcomplicate things here for this scenario, but there's less of a difference because of that in this scenario particularly, but still 6% higher, even with it being kind of the worst case scenario of taking all the money out, still 6% difference. And then with net proceeds, there's sort of 20 grand odd difference on the business sale, which actually only quantifies to 1.3%. So percentage wise, there could be a saving. 20 grand's a lot of money, but this business is worth a lot of money. So it doesn't make a lot of difference percentage wise. But if you imagine when you've got a very valuable business which is being sold, even 1% or 2% puts a lot of money in your pocket. So eking out these little percentages here and there, and this broadens throughout all of my financial planning, really makes a difference over the long term with your wealth and your business and your earnings and your income and your family and your retirement planning. And it all adds up. So this is an example there. This needs to be looked at for your scenario. These are just assuming various things here. As I say, it's quite a broad comparison, but you can come to me and go to your accountant for more specific ones. I won't go on about the same thing all evening because that was quite similar, all those slides, but it is really important. We're going to move on now to pension planning. And as I say, my day to day with new clients is focusing very much on this as the first port of call, especially for clients who are, over the age of 45, say, and are not approaching retirement, but thinking about, kids are growing up a little bit and thinking, right, I've got more money to start saving away and thinking about the future. First of all, start if you've got an NHS pension. Do you know what your schemes are? There's 3 different schemes. Most will have 2. Make sure you've got a forecast. Look at your annual allowance usage, and if you're over allowances, look at scheme pays. Have you had your McLeod judgment remedy figures? Do you understand what that means? Do you understand what your options are? If you're not sure, come to us. We can give that assessment. And you've got to look if you're nearing retirement, when to commence. Are you taking the 95 scheme age 60? If you're past age 60 and you haven't taken the 95 scheme, come to me straight away. You should be looking at that. What to do with your other scheme? Do you enhance tax-free lump sum? If you're anywhere near age 60, if you're within a couple of years of age 60, you should be having this assessment to get ready because the decisions will roll around very quickly. So come to us, we can provide separate advice on that. State pension, clients often overlook it. It's, I'm just going to get a state pension. Nearly everyone will have this full state pension, especially if you're a business owner and you're working. But, checking yourself, your forecast, making sure you are on track for full. If you've emigrated here later in life, you might not quite be at the full 35 years. If your partner's not been working for chunks of time or you haven't, there might be gaps to fill, and it pays for itself within 3 to 5 years of receiving it. If you're making top ups, it's a bit of a no-brainer to make those top ups if needed. So have a look and get your forecast to make sure you're on track there. And then after those 2 are covered, most of our clients look at pension contributions, either personal pension contributions or if they've got a limited company contributions. Let's say we establish there's allowances available. How do I maximize my wealth? Best for retirement, pension contributions. Get tax relief and you can grow your money very tax efficiently. So this table of examples here, lots of figures, but what it looks at is personal pension contributions, okay? If you're not a limited company, we would be looking solely at personal pension contributions. And you get marginal rate tax relief. So if you're a 40% taxpayer, you get 40% tax relief on your contribution. If you're 45, you get 45. If you're earning sort of 120 grand a year, for example, and you put 20 grand into a pension, you get 60% income tax relief because you avoid having that bad tax bracket. It moves your adjusted net income back to 100,000. You keep your personal allowance. Really, really important you get your head around the opportunities for this. We've kept it reasonably simple in these tables. We've looked at examples of 40% tax relief, 20% tax relief. Only, of course, if you're a higher earner, you would amplify the potential benefit. And we're looking here at not just me saying, oh, you get loads of tax relief now, that'd be lazy. We're looking at in future, you will take money out your pension in retirement. 25% is tax free, and the rest you pay your marginal rate of income tax. We've got to look in future what you'd pay tax wise and look at what the impact is. It's easy for me to say you get loads of tax relief now, but if you're a 40% taxpayer in retirement, is it worth it? And the answer is yes. And we often get clients who say, I'm going to be paying 40% tax when I take the money out in retirement. What's the point? Well, these tables show it. The top table is you're a 40% taxpayer now, and when you take the money out in retirement, you're 20%. If you look at the top line, 12 and a half grand in your pension now, costs you 7.5, 25% tax free, 20% tax on the rest in retirement. Just money in, money out, no growth accounted for. It's a 42% uplift on your money. It's an absolute no-brainer. If you don't have a large NHS pension, you don't have loads of properties, and you think, well, it's on me to kind of, even if you've got a business, because that's going to be a lump of money all at once, and that's not going to impact your future income tax situation. This is a no-brainer to put money in because you're going to get a massive uplift on your money if you're going to be a much higher taxpayer now than you are in retirement. Any growth amplifies this benefit because if you imagine in this scenario, you've got 12 and a half grand in your pension, it's cost you 7.5. That 5 grand difference is in your pension and growing. So if the funds grow 50%, 100%, 200%, the last 10 years, funds have grown, high risk strategies, 200% in 10 years. All of that's in your pocket. You're getting growth on the money that would have ordinarily been sat with the tax man. So you're amplifying your benefit with growth as well. For clients who are 20% taxpayer now and will be 20% in retirement, there's still a benefit, but money in, money out is only 6.25. If you did any investment where we could guarantee you 6.25% benefit at least from the start, you would still do it. But of course, it's nowhere near as beneficial as if you're going to get a high tax relief now and then lower in retirement. And the most common for our clients is they're higher rate taxpayers now, and they're probably going to be higher rate taxpayers in retirement. So what's the point of adding to pension if I've got allowances? Well, if you're 40% taxpayer now and 40% in retirement, there's a 16.5 or 16.67% money in, money out benefit of putting the money in because you get 25% tax free. And as that money grows, that benefit is amplified. That is still extremely beneficial to do. So this has hopefully quashed a few misconceptions, if any of you had them, which I often get of, it's not worth saving to pensions now. They're going to remove inheritance tax relief. Well, they're in the same boat as everything else then. Your ISAs, your properties, your cash in the bank. That doesn't mean that it's not impactful for your long-term planning, but you're still going to be better off, much better off adding to pensions, even if you then have to pay some tax taking the money out as opposed to just leaving it on to family. This slide talks about limited company contributions, more commonly done. As I say, more of our clients are limited company. Really, really simple. If you're a majority shareholder, so controlling shareholder and director, 25% shareholder or more, you should be able to put what you want in within the realms of your shareholder agreement. So, your share of the profits to a pension as your choice of remuneration, corporation tax fully on the contribution. And then it's moved out of the company into personal ownership, into your personal pension. Without having to pay corporation tax, without having to pay capital gains tax, without having to pay income tax at the time. Then, of course, in future, when you take your pension, you got 25% tax free and then marginal income tax in future. But it's a really good way of moving profits out of the company. That's why in that example before I talked about it being a very common strategy and why people incorporate so that they can funnel money over from their limited companies. Let's look at an example again, like the last on the uplift, because we're looking not just at tax relief now, but at if you then take the money out in retirement. This has got no growth at all accounted for. This is just money in, money out. 50 grand profits for a company. The first column there is showing aside from pension contributions, the best chance you've got of paying the least tax, which is just keeping the money in the company and not taking it as dividends. I don't recommend this with hundreds and hundreds of thousands because it means it's sat there doing absolutely nothing for years potentially. But strictly just in terms of tax, it's a lower tax, capital gains tax, than it is taking the money out as dividends and paying high rate dividend tax. So we look at that as an example of net money in your pocket. 50 grand profit gives you at the bottom after corporation tax and capital gains tax, 30,750. Okay, from 50 grand. And then let's say that 50 grand is added to a pension instead. We've looked at an example here. If you're a 20% taxpayer in retirement or a 40, if you're a 20% taxpayer in retirement, you get £42,500 back. Just no growth accounted for, just money in, money out. And if you're 40%, it's 35,000 back. So you can see there 38% uplift, it notes down the bottom. If you're a basic rate taxpayer, and a 13.8% as a 40% taxpayer. So even if you're a higher taxpayer in retirement, you're going to get big benefit by adding in from a limited company to a pension. This table here just illustrates those amplifications of the tax relief. It should be intuitive, but it sort of brings it home here. So if you're saving 20 grand a year, sticking it in the bank and it keeps pace with inflation, over 10 years, you got 200 grand. It's all kept pace with inflation. Over 20 years, 400. Let's say you put in an ISA. People think, oh, ISAs are tax-free growth. They must be the best. Well, pensions are the best because of the tax relief. ISAs are very good. But let's say an ISA grows on average 3% above inflation a year. That shows the benefit of investing the money. You can't guarantee growth, but over the long term, markets grow. So being active and saving often, using that trend should give more in your pocket. And we can see that there over 10 years and 20 years, big difference with the cash savings. And the use of pension tax relief amplifies it hugely. This first box that's in bold shows the gross pension funds before you've paid tax on the way out. So again, I could be lazy and say, oh, look, you got 900 grand in a pension compared to the ISA 500, but you've got to pay tax taking the money out of the pension. So let's look at those below, 20% taxpayer and 40%. You can see compared to the ISA, it doesn't matter if you're 40%, still a lot more. This shows the benefit of amplifying these tax reliefs over time that you do not get with an ISA. You get tax-free growth with an ISA. You do not get any tax relief when you go in. So that should be enough to sort of demonstrate the benefit of planning. But as I say, you don't just willy-nilly whack money in a pension. You have to check your allowances, check NHS pensions, think about the access period. If you're younger, like I say I'm not that young, I'm 38, but I cannot access a pension until at least age 57. It's going to be under the rules next year, probably be age 60 by the time I get there. So it's long term. Got to be careful with not overstretching myself affordability wise, but assuming money's affordable, it's the best place to save your money. So other investment options. Pensions do not make up the be all and end all. I do not put every penny of my savings into pensions. As I say, in my stage in life, I need to make sure I have accessible money as well. So I run an investment ISA, and nearly all of our clients have investment ISAs where affordable, of course. You've got up to a £20,000 allowance in ISAs, and most people, if they have wealth, will invest their money, because what you're then doing is using the tax-free environment to try and grow and use that tax-free environment, as opposed to a cash ISA, which, yes, you get tax-free interest, but it can only ever go up by a few percent, whereas markets in the last year have gone up by 20%. And all of that's tax-free in an ISA. So using ISA allowances not just grows your wealth, but you can access an ISA at any point. I just moved house 3 months ago. I had to dip into my ISA a bit with the move, and then I can sort of replace the money as I go. So you can think of your ISA as a sort of working investment where you can take money out, go back in, take money out. That's how I use mine. Venture capital trusts are very common for especially younger investors now, because you get tax relief. And if you're looking at the term of a pension investment, you think, I earn a lot of money, I want some tax relief, but I am a bit wary about putting too much into pensions because I've got to wait 25 years or whatever it is. Then a venture capital trust can be a good way of getting tax relief now. And there's a 5-year term. They are higher risk investments, though. They are not for everybody. So they're only for people with appetite to take some risk. But they work well, usually little and often, to spread out risk for clients who are building a sort of portfolio of lots of different things. And I myself use these to get some tax relief as well, and I don't have to wait that long to get the money back. Investment bonds usually used for people inheriting or selling businesses with large amounts of money, but these are a really big cornerstone of financial planning and retirement for people selling businesses who have a chunk of money to invest, can only put a little bit into pensions and ISAs, what to do with the rest. Investment bonds, general investment accounts there. These are all investment products and they all have different rules about the tax on gains, on tax relief on the way in, like with pensions, on the rules of taking money out. With people with vast wealth, you usually would use a mixture of all of them. Ideally, what you want is pensions and ISAs, by the way, they're the best, and maybe venture capital trusts. Pension and ISAs are the best, and VCTs offer tax relief as well. You do the other types of investments usually to do larger amounts of money that can't go in yet to pensions and ISAs, and then can fund them in future, can also be used for inheritance tax planning. So they're lesser used for people who are just doing pension ISA, and it's more for people in retirement, but nonetheless are quite common for our older clients. We talk about cash portfolios here. I am not an advisor who suggests that you invest all your money. You need to keep cash. I keep cash. I keep a buffer. I've got my tax account. I've got extra cash. I've got a young family, so I need to make sure that I don't have everything invested just in case, I need money very quickly. And just to sort of make sure we're protected. And I have some sort of opportunities of investment or other things in the market. So you need to keep cash. You don't invest every penny, but keeping large amounts of cash, although it's safe, can lose on against inflation, or will lose on inflation over the long term. Certainly, at the moment, lesser so because inflation's kind of here and interest rates are here. But remember, you pay tax on cash interest unless it's in an ISA. So people say I'm getting 4%, but if you're a 40% taxpayer, you're getting 2.8, aren't you? Or 2.6, I should say. So it's not quite as good to hoard cash, but nonetheless, cash is a very important part of our planning, and we always work with clients to build a suitable cash portfolio first before thinking about investments. Tips to growing your wealth. We note here tax efficiency of growth, not just buying a load of shares, not in an ISA. Saw a client the other week, 400 grand in shares, growing by 200,000, hadn't used their ISA allowances. They could have put all of it in ISAs and not have a tax bill to worry about. Now they're saying, oh, I've got to pay a load of tax selling them. Well, yeah, you should have used your ISAs. So that's an example of poor planning. Make sure your investments are going to grow tax efficiently because it puts a lot more in your pocket using these allowances that are there and picking the right products. Spreading risk and diversifying, don't put all your eggs in one basket. You might have different risk levels for different investments that are for different terms. You want to have a diverse portfolio. And if you're not sure what you're doing, work with a financial planner like myself or somebody else who can help you and give you that expert guidance. It's well worth having an expert aligned like you would with your accountant as opposed to doing your own tax returns. We've already spoke about this. Look at both partners. Don't just think me, me, me. If you're married, try to look, is it worth me doing this investment or both of us or my partner? Who gets the most benefit out of it? How are we likely to benefit most as a family? That can put much more in your pocket. And beware of excess property holdings. We get clients often with lots of property. I want to do pension, but I just want to property. Properties can make you decent money, but there's loads of tax when you buy them on the income, on the sale. There's a liquidity issue. There's an inheritance tax issue. This does not mean that I don't think anyone should buy property. If I had 5 million, I'd have a couple of properties, of course, and have it as part of a diverse portfolio. But you should definitely be wary of having too much in property holdings because of tax. And people often ignore the tax and say, I'm making this, but look at the tax. Are you making much money out of them? And is it worth having that liquidity issue and inheritance tax issue later in life if for that type of return when you look at the investment markets, what they've done recently. But again, it's not something I say never do property. If you have the appetite, they can work really well for clients who are wanting it as part of a diverse strategy. Some of you here this evening might be logged on because you self-invest already, and you might know a bit about this already. There's lots of this isn't holistic to cover everything. There's lots of different types of investment funds and products and assets that you can go into with your pension, with your ISA, with the other products I mentioned. This just talks about the three sort of main ones that are used. Investment funds being the most common. This is a fund managed by a fund manager from a company and a team who pick what's in the fund. You've got you've got ones that have a massive wide range, managed funds over the world. You've got some that just go in technology funds. You've got some that just go in UK smaller companies. You've got some that are tracker funds that just track certain indexes. So there's a huge wide range of different funds, and they all have their costs. And obviously, more simple they are, like tracker funds and just computerized, really, they'll have low costs. And an active one might be more expensive. It's not a good idea just to go with the cheapest ones. It's not a good idea just to pay for the more expensive and not look at how they've done. It's normally a balance there, but cost is a very important thing to keep down to give you net in your pocket. But there's a way of making sure your costs are low and you have good management. Um, Funds can deviate a bit in performance, good or bad, like be really good against the markets or really poor. They can deviate in terms of risk level. You might think, oh, I'm taking medium risk, but actually suddenly it jumps to an 8 out of 10 or a 3 out of 10. So they have their place, and we work, of course, with investment funds and the types of funds that we've listed there. More commonly for our clients, we recommend the second option, which is managed portfolios. You get 20, 30, 40 different funds from different fund managers, so very diverse. You'd have like Aberdeen and Invesco Perpetual and JP Morgan and all these different big fund managers in the UK managing different funds within a portfolio that matches a certain risk level and is managed with a diverse strategy, overseen by a portfolio management company like a stockbroker, effectively, who are making tweaks and changes to try and beat the markets and protect you if the markets are poor. This has always been around. This has been, discretionary management or stockbroking, and of course there's the benefit to it in terms of that active management. Until 10, 12 years ago, it was extremely expensive because you had to pay a stockbroker and they'd be managing with you a portfolio, a bespoke portfolio. There's still a place for that type of management, although we very rarely recommend that now, because what we've seen the emergence of in the last 10, 12 years is model portfolios, which have the same management teams doing the work, but they don't design a portfolio for you as an individual. They design a portfolio for a certain risk level, which you can then access through an advisor at a really low cost. So you're getting all the benefits of sort of stockbroking management, all the diversification of lots of different fund managers and a portfolio manager, but at a really low cost. And often these portfolios have fund discounts because of the scale of some of these companies. So we often see these strategies much lower cost than the equivalent managed fund. So it's a bit of a no-brainer for us to have these in most instances. They give consistency, a lot more consistency against the market, risk level consistency too. So we tend to favor these, but not for everybody. It depends on the type of product that we're recommending, the size of your investment, whether we have to consider tax on fund sales, like in general investment accounts, where you might want to control a fund that doesn't have changes made. So, but these are really good and worth looking at with an IFA. And stocks and shares, the most common for clients who self-manage is stocks and shares, and it's traditionally the cornerstone of the investment market. Investment funds have stocks and shares within them as part of a diversified strategy. Quite simply, in terms of risk level for funds, just jumping backwards, the more you have in stocks and shares, the higher risk your portfolio will be. That's a simplification. There's other factors of diversification, alternative assets and commodities, other things, but it is really the main part of it is how much of the portfolio is held in stocks and shares. And if that's 70%, what's the other 30% held in? Cash-based bonds and gilts and things like that, maybe some property funds and other things. So stocks and shares are always going to be a big part of investing, but a lot of people will hold direct stocks and shares, and they are all individually considered high risk. That doesn't mean you shouldn't invest in them, but they're all considered high risk because a company individually can just do wild things against the market, amazingly good, amazingly bad, in the middle, and that creates that risk. Managed funds with 3,000 different stocks within and all other assets, as diverse as that is, will have less chance of huge deviations because it's spread out. And that's what most clients want, is that consistency against the markets rather than the chance of it boom or busting. So really careful that you should consider all your stocks are individually high risk, although if you have 50 of them, you might consider it's brought down a bit, but they are still having that chance of variation. It's really hard to build a diverse range with just stocks, even if you had 200, because you're typically going to lean on tech, 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 tech. Usually in the US, they're the big stocks, and then there's going to be other. But it's really hard to build. We don't, as advised financial planners, build stock portfolios for clients. We use managed portfolios, funds that are much more diverse, much more well managed, can be a lot quicker to react to the markets with fund managers and portfolio managers who are looking daily. Um, but um, they do have benefits, no annual management charges for the stocks because it's a share. You do have trading charges, but you're not paying any annual management charges because you've bought the stock. It's your shareholding. So be wary if you have a large portfolio of stocks and you think, well, they're growing. It's fine. There are risks there, but we often have clients who might have, 1 million invested with us. They might keep 100,000 to, if they like trading, to keep stock picking because they've done it their whole lives. They say, I don't want to risk, my whole portfolio. Please manage it with me. But I want to keep doing this, and I'll have 100 grand in an ISA, for example, that I'm stock picking with, because I enjoy doing it. And we have a few clients doing that. And of course, that's understandable. I get it. This is my field. So I want to be the same. Um, Tips for strategy: diversify as you grow. Diversify anyway, but as you grow, the more money you have, the more different things you should have. Don't keep adding to the same fund. If you've got a pension already, you've got the same managed fund, you're adding 40 grand a year, it's going into the same fund. That's madness. You got to spread out. And if you don't know what you're doing, get advice because you are increasing your risk of that fund if it has a stinker affecting your investment. So don't put all your eggs in one basket. Seek expert guidance if you aren't sure. And then in terms of risk strategy, we often get we're big advocates of split risk strategies. What I do myself, I advise all of our clients what I would do in their scenario. That's how it should be. I'm not sure every advisor does exactly that, but it's how it should be. You should advise people what you would do yourself if you're in their boots. And I personally have a split risk strategy because at my stage of life, my pension is high risk. I can't touch it. Doesn't matter if the markets do that in between. It has the most chance of long-term growth if I go as high risk as possible over 20, 30 years. That's what most people do. It's what default pensions do for your employees. If you've got a business or if you are an employee, they go to 9 out of 10. But my ISA, I've got some in high risk. I had some in medium because I knew I was moving house, for example. So I kept, just in case, I kept sort of some at a more medium risk level. And you might consider doing that. And we often do this for clients. It's not for everyone. Some people want to keep it simple. Look, I'm a 6 out of 10. I want everything a 6 out of 10, or I'm an 8 out of 10 or 4 out of 10. But we often do it for clients. And I think that's what people like about our services as well. We're not trying to make our lives easy because it is more work and it is more hassle and more thought to the process. But it's probably right because you're not going to access all your investment money at the same time. So why should you take the same risk level with it? If you've got one fund or one portfolio, or even multiple, but they're all in the same risk level, why should you have it all aligned to the same thing? So considering that split risk option is really important because you can break your money down into the next 5 to 10 years, potentially the next sort of 10 to 20. And then really money, some people say, probably won't need that. It's probably for the family, but it's there if we need it and we can go high risk with that. So that's really important to think about when you're investing as well. A lot of you here this evening will invest already. No doubt you'll have had amazing results the last 2.5 years. These are the investment markets over 5 years. It's example portfolios matching adventurous, medium, and cautious broadly. Intuitively, blue line, the top one being the more adventurous. As the markets grow, the more adventure you take, the more risk you take, more stocks and shares within the portfolio, for example, of funds that you have, the higher the growth in those growth times have been. And if you focus on March last year and March this year, which is the two dips that we've seen in more recent times, although they've recovered quickly, there were more substantial dips for the more risky portfolios compared to the medium and the low. It does go both ways. Of course, we're advocates that over the long term markets will grow, but nobody knows what's going to happen in the next month or 6 months in the markets. Nobody knows. They've been very, very strong. The so-called experts a year ago in the papers were saying markets are at a high, the crash is coming. And if you'd have listened to them, you'd have missed out on 20% growth in the last year broadly. So they don't have a clue what they're talking about. And they've stopped talking because probably some people did follow their so-called guidance and come out the markets and miss out on this tremendously good growth period that we've had. It is counter to what's going on around the world, but markets do not follow what intuitively you think they should do if there's a conflict going on or Trump said this or or this has happened, sentiment in the markets is still very high. That doesn't mean that we know that they're going to keep going up and up. We don't know, but you can see that anyone invested has had a very good period recently. By the way, if you look back at the start of that graph after what was a more tricky period in 2022 in the Ukraine conflict, so it wasn't all smooth sailing for the 5 years. It's more than made up for it recently. The markets have been really, really strong. People have made a lot of money, and our clients have in this period. We show here an example of the benefit of financial management. I know I would, of course, say that, and only our clients who, work with us could attest for it. If you haven't had advice before, it's hard for you to visualize the benefit of the overall financial planning side. And people often think about, oh, it's investment management. So they will pick something, a fund or a portfolio that should beat the markets. We've got some details here on how that can manifest itself with performing better than the market. But financial planning is much broader in terms of helping you and your family reach your goals, whether you're working, whether you're planning your exit, whether you're retired or retiring. It's making sure that you have the information to make sure that you're on track, and using all these different allowances and having guidance on all various things of financial planning in your life, not just picking a pension and growing it for you. We are very holistic in terms of our advice, and we list all those areas there. Performance-wise, got some examples here of risk level 9, 6, and 3. The average for the markets versus an example managed portfolio, Wealth Select, which is provided by a provider called Quilter. We work with the whole market. There's been better performing portfolios. They are a very good performing portfolio, but there have been some better there. We're not just picking the best performing. And you can see there's a big excess against the market averages over the longer term, especially on performance. And it actually increases the difference the lower down you go. The reason being, if you look at the risk level 9 over 10 years, there's a 31% difference, which is high. But it jumps to 37 at risk level 6 against 100%. So that's more than double the percentage difference, for example. And then it's double the performance for risk level 3. And the reason for that is there's more strategy deviation the lower down you go, because there's less in stocks and shares. There's more decisions to make in terms of what else the portfolio goes into, in terms of global cash options, fixed interest, gilts, property, commodities, and there's more deviation of strategy, and that's why the managed portfolios do a lot better. So if you are a more cautious individual, you would likely see even more benefit than a higher risk individual from active management, albeit there's benefit for both. These figures can't be guaranteed, but these are the figures of these portfolios against the averages and what our clients experience outperforming the markets. Finally, retirement income planning. I just thought I'd sort of sign off with quick comments on this. We're maybe fast forwarding. Some of you here might be like 26 and thinking, great, okay, I'm not doing it. But actually, clients in their 20s are more organized even than even my generation, of thinking ahead to say, where do I want to be? The average retirement income in today's money is 35 grand a year for a household. That if you do well in life, you want more than that. The average for our clients is 60 grand a year. We got clients spending 400 grand a year. We've got clients spending 25. The average is about 60 for our clients a year for a comfortable, and then bits on top. To give you 60 grand a year, just talking about if you have lots of state pension, you'd need to raise 37 grand a year in today's money. You'd need about 700 grand invested. Okay. And of course, that's just to give you that income. Most people want extra money on top to help family, to leave on death, in case they need care in future. So that's not saying you need 700 grand, but it's give you in a ballpark of what would I need roughly age 60 odd as, say, investments in today's money. Where should I work to give myself a reasonably comfortable retirement? Everyone's different. Depends on where you are in the country, what you want to do. Are you married? How many kids you have? But this is an example there to give you a bit of a sort of barometer. And planning income's crucial, not just sort of, I'll have a lump of money from when I sell the business, when I sell this property, I'll just use that. Well, taking it out in the right way, using your allowances, paying the least tax you can, using spare cash if it's available. You want to leave 100 grand, but use some more That's really important in getting the most out of it too. And part of the financial planning process, which we do for clients, whether they're starting, approaching retirement, or more commonly for clients retiring or in retirement, is cash flow forecasting, showing you a picture of your wealth now, how it might grow over time. Scenario if you sold a business at this stage and had this money and used it, or sold this property or inherited money and spent this amount in retirement, how your wealth would look. Can you afford to spend that 300,000 on a holiday home? Can you afford to help your children with 100 grand each towards buying a house? People aren't sure without these forecast models to really prove to them. And sometimes they can't, but often you can, and it helps reassure you of your planning, not just of saving, but in terms of the other planning that you have. It's not just about growing money, it's about using it to help yourselves, help your family. And this really helps visualize that for clients. So it's a very valuable tool for a financial planner and for me to work with our clients and keep them informed on where they are. That's enough chit chat. Thank you for everyone who's made it to the end in this heat. My contact details are here and they'll follow after this webinar. I'm going to stop sharing my screen now. Chris, you still there? Have you fallen asleep?
I am here. I am here.
Perfect. Have we got any questions from the audience that we can wrap up with for 5, 10
We
minutes?
have none at the moment, I think, because they're all stunned. The only one I've got is, well, the only things I learned are I like the diverse portfolio, and I think that's quite important because a lot of people do just like a property, don't they? Just think, oh, property, property, property. What else did I look at? The pension scheme always amazes me. You know, the old NHS pension scheme. You know, there's one of three schemes. Which one are you in? All that sort of stuff. And I just think, unless you've really looked at it and asked a specialist, you're not going to have a clue, are you?
It,
It's so complicated.
it's complicated because the NHS is an amazing thing and the people that work in it are amazing too. But the administration, obviously, of some of the services, I'm sure everyone works in the NHS has had their issues, but also of the NHS pension is extremely poor. Not every public sector pension is like this. The teachers' pension
Mm,
has their ducks in a row. They have a proper online system with loads of information in one place. They've sent out proper information on time after the McLeod remedy and on the pen that you can read it. It's concise, you understand it.
mm.
NHS pension is an absolute shambles. So I'm not surprised people don't know because they don't make your life easy and you do need an expert to tell you.
Yeah.
And we can help
So,
with that. Yeah.
so I think that's it. And really, I think probably as it's just past 8 o'clock, not 9 o'clock, we probably should let people go and have a cup of tea and dip in the, well, maybe a cold beer actually, or a glass of water if it's still hot wherever you are. All I've got to say is thank you very much. I always find it fascinating, really, because I think it's one of those ones, isn't it? It's a little bit dull, to be brutally honest, because people look at it and go,
None
"Oh my
taken.
goodness," but actually, I think it's really interesting. Do you know what I mean? I think when you look at it as a subject, I think people sometimes go, "Ugh, investment, pensions, all not very sexy." But actually, I always find whenever I listen to you, I always learn something. I always learn something. And I think
Even
it's all
after all these years,
yeah,
Chris.
yeah. There's always something you think, yeah, you should do that, or you should think about that, because I think that's the other thing, isn't it? That even though it is after all these years, things constantly change.
Yeah, they do.
So you have to keep reviewing and keep
That's it.
understanding and reassessing. Otherwise, you do fall behind. And
Yeah.
everyone earns money. We earn money for our futures. So let's try and keep as much of it as we can,
Yeah.
rather than get to the end of it. Oh, if only I'd have done.
Yeah.
And that's why I think people should talk to you. Or any
Yeah.
IFA, obviously, preferably talk to you. But as Adam is my own personal IFA, I can wholeheartedly say he gives a pretty damn good service. Um, but just say thanks, Adam. That was really good.
Thank you,
Thank you,
Chris.
everybody, for listening. I hope you made loads of notes. And as Adam says, if you want to ask him any questions because you just haven't got any now, his contact details are on the screen, or you just go to Frank Taylor's and they'll be able to forward them on. But thank you
Brilliant.
very much. Have a good rest of
Thanks,
your evening.
everyone.
Cheers,
Have a
guys.
good evening,
Thanks very
guys.
much. Bye.
Bye bye.